The following program is to provide entertainment and information. It is not considered to be any legal or investment advice. Good morning, appraisers. Let's talk some real estate. You're listening to the Voice of Appraisal, the #1 appraisal podcast in all of America that always brings you the latest news and information from the front lines of the real estate market. Anything from market conditions, appraisal regulations, cryptocurrencies, big bank news. Folks, you have a question, we have all of your answers. We are the one-stop source for all of your real estate appraisal information needs. If you want to be in the know, you have definitely tuned in to the right show. I'm your host, Phil Crawford. Happy to have all of you here with us today. Kevin, huge show today. Huge.
I was just going to say, I really appreciate all the listeners out there, and I know they're very faithful.
Yes.
This show, I'm going to say, this show
is one of our best.
Is fire.
Fire. It's on fire. And you know what? There's a lot of things we have to talk about. We have to talk about the situation where somebody, one of the big 6 appraisal companies sent a felon into someone's house. How many times, Kevin, how many times have we said on the Voice of Appraisal podcast, do not send an unlicensed or someone that's not connected to an appraisal office, do not send that person inside of a home. How many times have we said that? How many times have we said that?
7 years.
7 years.
7 years.
I don't mind the product if it's a drive-by, if it's a low LTV, as long as the scope of work matches what the risk assessment is. But you start sending anybody into these homes out there, you're going to start pissing off the homeowners, you're going to start pissing off the realtors, and guess what? Class Valuation just sent somebody into a house who's, I guess he was trying to rip off what was it, an armored car?
A courier van.
A courier van.
He's waiting to be sentenced. So they found him guilty. They're waiting to sentence him at $1.2 million.
Oh, he tried to rip off $1.2 million?
Yeah.
Well, then what that's a wonderful person I want to have inside my house.
Come on in.
Come on in. It's okay.
Jewelry's over there.
Jeez, okay. Let's not even get into it. We're going to talk about the bifurcation. We're going to talk about Fannie Mae. We're going to talk about Freddie Mac. We're going to talk about appraiser bias. We're going to talk about FHFA. We're going to talk about all of this with an extremely awesome person, an awesome regulator. We've got an interview with Dr. Mark Calabria.
Like I said, fire.
Fire. Dr. Mark Calabria is going to be on the show today. He was the gentleman that ran FHFA during the Trump administration through 2020. Remember the truck cast we did? The truck cast? We had data point 0. That was March 5th, 2020. He got us through some very difficult times. I'm telling you, if it wasn't for what Mark Calabria did over at FHFA in 2020 and 2021, there would have been a run on equity. There would have been a run on banks. There would have been another bailout. It would have been mass hysteria. But Mark Calabria, I've always been very impressed with him. He's got a new book out. The name of the book is called Shelter from the Storm. I want all of you to go to Amazon and get Shelter from the Storm by Dr. Mark Calabria. He'll walk you through. It's a very easy read. It's a very quick read. He'll walk you through those crazy, crazy events that took place during the coronavirus and the coronavirus shutdowns and everything else. So that's it, Kevin. We're going to stop talking. We're going to stop talking, and we're going to get to the interview. So, ladies and gentlemen, here is our interview with Dr. Mark Calabria. So, ladies and gentlemen, we have a very special guest on the Voice of Appraisal podcast today. We have the one and only Dr. Mark Calabria. Mark Calabria, who ran FHFA under the Trump administration, who got us through a very, very difficult time through 2020 and 2021 and into 2022. Dr. Calabria, how are you? And thank you so much for being on the Voice of Appraisal podcast.
Well, it's really such a pleasure to be here, and I really appreciate all those kind words. It's a delight to be here. I'm a big fan of the appraiser industry and really just excited to have my book out now that it's almost 2 months.
The name of the book is Shelter from the Storm. You go into details as to what happened during those crazy times in 2020 and 2021. And by the way, I'm going to say this right now from the very beginning. On behalf of all real estate appraisers across the country, we want to thank you. Thank you very much for 2 things. Number 1, not getting rid of us during those, terrible, terrible times. And number 2, basically having us have the most profitable 2 years of our entire lives. It was absolutely unbelievable. Appraisers made more money than they ever have before in 2020 and 2021 as we refinanced the entire country.
Those were certainly crazy years, and, we tried to keep the market going. Certainly had no clue they would turn out quite the boom years they did. But, we wanted to make sure that it was important, during the pandemic. And, it's important also to keep in mind we tried to do that in a way that we were protecting, the health of appraisers as well as the health of the general public, home buyers, mortgage borrowers. And again, that's the story we tell in the book. And again, I thought it was important to tell the story because I do believe it was a success, if I can be slightly immodest and say, I think what we did worked. And it wasn't by accident. It was designed. So to me, it's important to talk about what we designed, the choices we made, even the uncertainties we faced. I like to think that if I'm known for anything, it's candor. And the book has a fair amount of candor, both about myself and the agency, Fannie, Freddie, and the mortgage market and the problems we were facing. So I hope people appreciate the nuance that's there.
I got to ask you this question. You're a Cato person, correct?
I'm currently a senior advisor at the Cato Institute, which is a think tank here in Washington, D.C.
Okay, so what I learned in 2019 was there are different think tanks in Washington, D.C. Remember, I was going into Washington, D.C. in 19 as a layperson, not really understanding certain things. And I noticed that you were with Cato, and there's the American Enterprise Institute, and there's the Brookings Institute as well. And when you look at Fannie and Freddie, when you look at FHFA and the structure of that organization, can I ask you a simple question? How did someone like you get to be in control of that? How is that even possible?
Great story. And you kind of touched upon this a little bit. And yes, there's a whole lot of think tanks in Washington, and obviously think tanks have started to grow up in state capitals around the country and elsewhere. And, you can kind of think about this in a couple of margins. Many think tanks have a sort of a political affiliation. You think the Heritage Foundation or American Enterprise Institute, you think about more Republican-leaning. Obviously, like Brookings or for Center for American Progress, they tend to be more affiliated with the Democrats. Where Cato tends to be, libertarian and stand in the middle. So there are issues upon which we agree with the right, and then there are issues we agree with the left and kind of go our own way on a number of things. But a consistent theme is we at Cato do tend to be skeptical of government action and tend to lean toward freedom for the individual. To kind of bridge that to, how I ended up there. You may normally ask, well, how could somebody who's so skeptical of government have ended up spending so much time in government? And part of the bio, of course, is I spent the years leading to 2008 and the financial crisis on the Senate Banking Committee. First, I was very fortunate to start working for Phil Gramm and then later Senator Richard Shelby, and worked on the legislation that created FHFA, the Federal Housing Finance Agency. So I had that history of having actually worked to bring the agency into existence. And the real purpose of the agency was as a safety and soundness regulator to kind of control that moral hazard created by the implied guarantee behind Fannie and Freddie. So, FHFA is not a grant-making agency. It's not there to redistribute income or tax the public. It's really there to be frank about it. It's there to make sure Fannie and Freddie don't blow up the financial system. So that's why it's important goal. And so we can debate whether we should have a Fannie and Freddie, the structure we should have. Right. But if you're going to have one, you want a structure like FHFA.
It's amazing that you said that because in your book you talk about MBS, mortgage-backed securities. I did not know that that market is second only to the Treasury market. I had no idea about how big it is.
Absolutely. Banks, insurance companies. I mean, obviously the Federal Reserve holds a lot of mortgage-backed securities, so it's spread throughout the system, really interconnected. Right. And so I was working at the Cato Institute in 2016. I didn't really do any work on the campaign because we are very nonpartisan rather. And because we aren't an advocacy organization the same way, we don't get involved in political campaigns. But it happened to be that a number of people I knew were involved working with then Congressman, later Governor, and then Vice President Mike Pence. And so their office reached out to me to gauge my interest in coming to be chief economist for Vice President Pence. And, of course, that happened 2017, 2018. I spent those years at the White House working on tax reform, so was a key member of the team that got us the 2017 tax reforms. I wanted to get the corporate rate even closer to zero, but, we did what we could. One of the most inefficient parts of our economy, and worked on trade issues as well. I worked on the USMCA, the renegotiated NAFTA. I started work on a free trade agreement with Japan that we were never able to finish. But again, number of trade issues. And so it happened that, as you recall, when the Trump administration came in, former North Carolina Congressman Mel Watt was the head of FHFA.
Right.
And at that time, it was a term appointment that was independent of the president. And so there was certainly talk at the White House of trying to remove Watt, but ultimately he served his term, which ended at the beginning of 2019. And because I had spent so much time on mortgage issues and had been involved with creating the agency, I was one of the people considered. I mean, I think I was one of 5 that were considered seriously. And we went through that transition, and I ended up being, the nominee, thanks to a large degree because of the support not only of Vice President Pence, but also Larry Kudlow and, of course, the president at the end of the day.
Yeah.
And, of course, having the support of Senator Shelby, who was at that time chair of appropriations and very influential in the Senate. So, and I also thought it was something that made sense for me. I mean, for instance, I was considered for a little while to be one of the governor's spots at the Federal Reserve. And I looked at it and kind of said, that obviously the Federal Reserve is an important institution, but I wanted to run something, to be frank about it. And I felt that I had a lot of expertise in the mortgage market. Again, as I mentioned, I had helped create FHFA, so I felt a little parentage, if you will, little responsibility for its success. And to be frank, I felt like much of the conservatorship and the drift had been in the direction away from what Congress intended. So I really felt like this was a problem agency. These were tough issues to fix. I'm definitely not someone who's like, let's go somewhere where it's just you could hang out every day and easy. I used to joke inside the agency that I was on good enough terms with the president and vice president that if I had wanted to be the ambassador to Bahamas and sit on the beach every day and drink fruity drinks, I could have talked him into doing that. And maybe in retrospect, maybe I should have, but that's a different.
Well, I will say one thing though, and that is that even though you were in charge of FHFA during the Trump administration, many people in Washington, D.C., from both sides of the aisle have a lot of respect with you. And I think that's very important for people to know that. And it's your overall skepticism that makes you very popular with real estate appraisers, because real estate appraisers are skeptical about everything.
As you should be. I mean, there is a kind of as Reagan used to say, the trust but verify. Yes. I also tried to be extremely transparent. And, I feel like the government agencies often try to hide the ball and try to leave their options open, and try not to signal what they're doing. And I thought it wasn't. So to some extent, I spent, like I say, 7 years on the Senate Banking Committee doing oversight of agencies, including FHFA and its predecessor agencies, OFAO and the Finance Board. And to put it bluntly, I essentially took all of my years of what I thought regulators were doing wrong and tried to correct it. And, I tried not to be a hypocrite in that regard. Here are my, list of dozen complaints about how many regulators behave. And I told myself, I'm not going to do those things. I'm going to try to live up to the standards and criticism I've applied to others. And again, try to be very transparent about what we were doing, tried to really kind of, bring some sunlight to that, including the issue of appraisals. I'll be frank and say I was shocked at, particularly coming from Freddie, but both the GSEs, the kind of view of that they could, over time substitute for collateral valuation themselves. And they certainly saw themselves as kind of the smartest players in the book. Yeah. And I worked on appraisal issues, on the Hill, and I was in college during the savings and loan crisis in grad school. So, I was not old enough to have been there for FIREA and fiducia and those sorts of things. But it was always a bit of an obsession with me, to be frank about it. Even leading up to 2008, I was known for giving other staffers, savings and loan crisis reading lists and saying, these are the kind of things we need to be worried about. And obviously, out of the S&L crisis, really came the changes in the appraisal industry. Sure. And so we did hearings on that when I was on the Hill. It really was something that I had followed pretty quickly. And of course, we all follow the changes, such as, those that then Governor Cuomo enforced upon the industry. And so it really was a concern of making sure we get the numbers right. And I also began early in my career working at the National Association of Realtors, which is interesting in two ways. It's interesting, it's sometimes the realtor who kind of will put some pressure on hit the number, but the NAR has always had a soft spot for the appraisal industry, and it's often been an ally, even if it's often sometimes in the transaction level where some of the pressure's coming from. It's a push and pull.
Yeah, well, we can see that soft spot coming up from the NAR right now because, as you know, Fannie and Freddie. So let's take ourselves back a little bit to the crisis situation where we had, like you said, we had to keep people safe. We had to get accurate collateral evaluation. So that required some, workarounds, some of these bifurcated products, some different things like that. Well, just recently, Fannie and Freddie have now basically tried to mainstream, if you would, this bifurcated process where people go out to the homes. They're not the appraiser. They're not connected to the appraiser. One of the most recent firms just hired a convicted felon by mistake to go inside of a house. I mean, these things happen. It's not a big deal. But
mistakes were made.
Mistakes are made, right? Exactly. But you look at that and you say, okay, now that the realtors understand that there could be these third-party individuals coming inside these homes, we don't know who they are. Now they're starting to say, hey, we want our appraisers back again. We really do value what they do in the ecosphere of real estate. And I think that's starting to come out more and more because of the actions of Fannie Mae and Freddie Mac right now.
And I would agree with that. I mean, I think that other parts of the industry are starting to see that if you do minimize the role of the appraiser, that there are unintended consequences. There are costs that come along with that. And I really should emphasize, because to some extent, I think this is almost a bit of a, perversity, unintended consequence in that the modifications that we put in place during COVID, like allowing greater use of drive-by appraisals and moving away from full appraisals, A, those were meant to be temporary, and B, they were meant to be for the physical protection of the appraiser.
Correct.
Because again, in the spring of 2020, I mean, we were still trying to figure out how transmission was, and we didn't want to have to force someone to be in the house, especially the borrower was not going to want you in the house.
Sure.
So this actually was, I mean, to me, to see something that was set up to actually protect appraisers sometimes being used to essentially undermine the industry, is really concerning. Again, none of this stuff was meant to be permanent. I'll also note, we understood that allowing some of those flexibilities would increase risk.
Right.
And so what we did in many of these instances was, A, we only allowed it for refinancings. We lowered the maximum LTV because we assumed, okay, there's going to be more error in this process. How do we safeguard that? So we really were targeting this for, essentially neutrality. We didn't want to have any additional credit risk in the process.
Right.
So we put some safeguards on it. We also created a process where we would go back every couple of months and say, what's been the performance of these products? Are we seeing greater delinquencies, problems in the process? And so it was never meant to be, oh, okay, this is the new norm.
Right.
That was not meant to be the process. I'm sure you recall, before I left, we started an RFI, request for input process around collateral valuation. And partly this was a pre-COVID predominantly, because when I walked in the door in spring 2019, there really was an attitude of the GSEs that they could, over time, move more and more away from the appraisal industry, because they thought, and again, this was pre-Zillow shooting themselves in the foot, if you will, before everybody realized that, AVMs are useful, but they can't substitute for everything. So I'm not an anti-AVM guy. I'm just there are values to them, but there are limitations to
Correct.
them.
Yeah, that's
and
right.
And so they're not an end all be all. And so you really saw this force at the GSEs. Part of it is a mentality. There's really a mentality at the GSEs that everybody else in the process is a friction to be ironed out, and you're a bump in the road. And so, and again, and in some sense, this frankly is a challenge to the industry, to give a piece of advice. I think the industry needs to be able to impress upon policymakers in Washington and the general public, the value, because to me, the appraisal really is important for not just protecting the ultimate investor and the taxpayer, but the borrower,
the consumer.
And exactly, absolutely,
the consumer.
Important consumer protection component. But I'll tell you, that's often lost in the conversation in Washington. Yeah. And I think that the industry really needs to be louder about the role they play and the value they bring, because they're all important things that I believe in. But I can just tell you, there's so much emphasis about, let's squeeze the pieces of the puzzle so that we can get more people into home ownership. And let's remove every obstacle possible to get somebody into a home, regardless of whether, they're able to stay. And that's one of the things that I really flipped. And I think this is an important point, because I'll start with the observation.
Sure.
My tenure at FHFA, witnessed the largest annualized increase in minority homeownership since we've been keeping annual numbers.
Yes.
And we did that while we were strengthening underwriting standards, not weakening them. Mm-hmm. And I think it's really counter to this narrative that you need to get rid of the guardrails to get more people into housing. And unfortunately, a lot of people in Washington look at the appraisal industry as a guardrail that's keeping people out of homeownership when, as you and I know, it's a guardrail that makes sure that people can stay in homeownership.
That's right. That's exactly right. That's very well said. Let's bring up this issue of risk here really quick, because you once said on Larry Kudlow's show that lending without risk is like religion without help. And given the fact of what Fannie Mae and Freddie Mac are doing and throwing sort of risk out the window, are these two entities going to hell, Dr. Mark Calabria?
I mean, there is a real risk. I mean, so we've done a lot of things. I'll put it this way. When I walked in the door, Fannie and Freddie were leveraged 1,000 to 1. A strong wind would have blown them over. We started raising, and this is true. We started raising capital in the fall of 2019, which was critical because, again, to put that 1,000 to 1 in perspective, they had only $6 billion in capital behind $6 trillion in risk.
Oh, geez.
And the losses during COVID, which again, these are things that were appropriate to take and assistance that was appropriate to provide.
Right.
But the cost of COVID to Fannie and Freddie were $6 to $7 billion. So if we hadn't started raising capital in 2019, they would have failed.
Unbelievable.
So the fact that we were able to avoid that almost near certainty. And again, there were other pluses. I mean, this wasn't necessarily intended, but one of the, silver linings of those years worth of boom was a very large amount of Fannie and Freddie's book was pre-2008. And the importance of that is that they were often getting very G fees, 12, 14 basis point G fees that didn't cover the risk. And one of the benefits of COVID was we were able to reprice most of the Fannie and Freddie books. So huge part of the book where you went from getting 12 basis points to 50 basis points or 60 basis points. And it'll put them in a much better cash flow position next time the market turns down, which may be happening now. So I feel like we've gotten them in a much better shape. I'm not at this point willing to say that they will absolutely survive the next housing downturn, but we really put them in so much better shape than they were in, say, 2018.
Everybody that you were talking to at that time, a lot of people were coming to you saying that you got a lot of heat. I mean, you got a lot of heat. Yeah. People were saying that you were wrecking the economy. They wanted to bail out. They wanted to bail out. Now, one thing I've picked up from your book, it's pretty amazing, is how many times people want bailouts when just the smallest things go wrong. And you were out there and you were basically, holding your ground. You're self-described as a stubborn individual. You're hard-headed. That's what you say about yourself. But you had people out there like Christopher Whalen, King Mortgage Broker, calling you the Calabria virus. Yeah. He's calling you Calabria virus, saying you're destroying everything. I mean, you really held your ground at that time.
You kind of have to. I guess I could attribute it, for those who want a little geography lesson, Calabria is the toe of the boot of Italy across from Sicily. And, they say that Calabrians, the phrase is, dura testa, like hard-headed. So Calabrians are known throughout Italy for being the most hard-headed. So I guess I have kept that, generational legacy. But it's not, again, I should emphasize, we were always willing to change direction when the data changed. And that's the difference, is that, rather than, as I say, kind of like when in doubt, bail it out, which seems to be more the Federal Reserve approach, our approach was, what does the data tell us? We're going to look at the information. Is it justifiable? We have a public trust. And, of course, as Fannie's and Freddie's regulator, my first responsibility was to Fannie and Freddie, not to their counterparties or the servicers or others in the industry. Mm-hmm. And so, again, I took an oath to carry out the law and the Constitution, and I took it seriously. And so for me, we really did try to be very data-driven. And I think this is very topical because when you're in these situations, 99% of the calls you're getting are to bail people out.
Yes.
And so I understand. I personally, it's a longer conversation, disagree with some of the decisions that were recently made with Silicon Valley Bank and others. Mm-hmm. But I understand, having been in those seats, that the pressure is just overwhelming. And, of course, the easiest thing is to go along to get along. But, again, I'm I'm somebody who's, I try to be extremely transparent about it and try to, take feedback and adjust when I get new information. But at the end of the day, I mean, I think, one of the themes of my book, and I served in the George W. Bush administration at HUD for a little while with then Secretary Martinez. So I think I can get away with saying a little bit that President Bush says during the 2008 crisis that, we have to abandon capitalism to save it. And I think I'm making the argument in the book why I think that's wrong. In the fog of a crisis, it's even more important to be principled, because your principles and your understanding of the world are the roadmap.
Right.
And, if you don't have a sense of direction when you're lost in the fog, you're never going to find your way out. And that's kind of a theme of the book, which is rather than just abandon principle, keeping the principle and having that framework and having a set of beliefs is actually more important during a crisis rather than less. Let
me change the topic with you just a little bit here.
Sure.
Let's talk about a hot topic that's been going on in the appraisal industry for a long time, appraisal bias. And as you know, there's been a lot of news stories out there, New York Times, Washington Post, CNN, about appraisers being biased when it comes to their valuation. Your thoughts on appraisal bias, and did you see any of that stuff going on when you were in charge of FHFA?
Let's start with that the administration has put out a bunch of things from Fannie and Freddie where they have taken quotations, and this is predominantly from some of the REO business, but, there's appraisal documentation, and I saw those appraisal write-ups when I was there. Certainly the fair lending team shared that with me, walked me through that.
Sure.
So I want to say, certainly some of the quotations and some of the language that have used, that's true, that's real, I saw that. But to put that in the context, I really think the administration is largely cherry-picking.
Okay.
Because, again, there are certainly anecdotes. There are certainly bad actors in every industry, and I think that of course, that needs to be dealt with. And certainly efforts by the industry to bring more diversity in the industry are helpful and important, I think should continue.
Sure.
But but I also had our econ team. So one of the things I thought was critically important, when I walked into FHFA, there was no standalone research division. All of the statistics and economics and evaluation were kind of mixed throughout the agency. And the problem with this, in my view, is you cannot have the same team that does the work evaluate the work that's being done.
Correct. Yeah. Correct. Yeah.
And so we set up a separate evaluation function. And so even though there's a fair lending group that's doing its work and collecting these anecdotes, we have the economics team doing statistical work, on appraisal bias. And to be frank, we did not see, statistical evidence of systemic bias in the Fannie and Freddie book. We saw incidences of misbehavior from individual appraisers. We didn't see something that suggested that there was an overall systemic bias. And those are two different issues.
Okay, let me ask you another question. Can we get a little deeper here? Let's get a little bit deeper, okay?
Sure.
Let's go to Dr. Andre Perry's book, Know Your Price. And I've read that book several times. In that book, he makes the argument that the system itself is systemically biased. So because of the history of a certain area or a certain neighborhood, because of historical redlining, because of historical lack of liquidity, that area is now impacted by this level of bias that is inside the structure of the system. As an appraiser, I look at that and say that is an issue, because I live in this neoclassical Milton Friedman sort of world where I'm looking at the establishment of market price and market value between supply and demand. That sort of goes into a different path where we're looking at sort of a societal problem that needs to be addressed. And I don't think that the appraisal industry at this time has the power nor the ability to handle that issue. So
your approach, that's correct. And this is a number of things. You see this in credit scoring in a number of instances where it is shoot the messenger.
Yeah.
So,
yeah.
Set aside the argument how real the underlying argument is, but let's structure the argument that I believe that Mr. Perry is making, which is that there is structural social issues that enter into the value of the neighborhood that for a whole number of reasons, and there's validity to that. Just as there is validity to there are structural reasons that there may be differences in FICO scores across race.
Okay.
That's different from saying that the appraiser is doing something nefarious.
Right, exactly.
You're reflecting the value of homes sold in that neighborhood, for instance. Of course, there's always some subjectivity, picking comps and things like that. But again, no evidence that I've seen that there is some widespread industry failing. And again, so what he is complaining about is a broader issue that's really outside of your power. And in fact, to me, he's arguing that you should stop doing your job. And again, my worry is I think what he's doing is what he's arguing for is actually harmful to the many of the families he wants to help. Because again, if what we do in the future is tell appraisers that they need to not take into consideration what similar properties in the neighborhood have sold for, but raise the price. And again, it's, as you know better than I, an appraiser it's an opinion. It's not an offer to buy. Nobody is actually saying the home is worth X. What the home is worth is what somebody will pay for it, which is something very different. And I worry that this pressure to over-appraise many of these properties will leave the very families that everybody's concerned about underwater. Because, again, you can claim this house is worth more, but if no one's willing to pay it, then it's not. And so, to me, and again, I've written about this in other I'm very sympathetic to the general issues. There are structural inequities. I mean, it's one reason, for instance, I'm a huge school choice advocate. I think we need to deal with the educational, inequities that leave many minority children behind. Mm-hmm. I think we need to deal with criminal justice reform, many of these other issues. I think we need to deal with labor market reform. There are issues here that are important. And, of course, I think we need to deal with a lot of the issues in local government that, ends up having some of these neighborhoods receiving, poor public services. So these are all very legitimate questions. I think the problem that I had both from the appraiser perspective, but also from what I've seen at Fannie and Freddie, in terms of underwriting, credit, and everything else, is people want to have the mortgage system be a quick fix for things that it's not a quick fix for.
Yes, very good point.
And I understand that these other things are harder to fix, but if they're not fixed, then you're just trying to distort the message. Right. Because again, just like FICOs actually are predictive of delinquency, appraised value is predictive of, how the loan's going to perform. And if we put somebody into a loan where the value does not actually represent what they can sell the house for, it's not doing them a favor. And I do worry about that, this kind of rather than dealing with the actual structural issues that may be causing those differences, we're just trying to call out we're trying to shoot the messenger. To me, that's the absolute wrong approach.
Well, I agree with you on it. I think it's important for real estate appraisers to understand where Dr. Perry's coming from, to understand that the concept and to know that is an issue and that does exist. It's how we address it. It's not based on 88,000 professionals to right a wrong that took place hundreds of years in America. And I think that's the issue that we come into. Now with Fannie and Freddie, they have – okay, so you brought up the FICO score. Let me get a little bit deeper with you if you don't mind.
Sure.
Okay, so you bring up FICO scores. Fannie and Freddie today have the collateral underwriter. It is their risk assessment device that they use on valuation. Do you worry, or being in that position, do they worry about the collateral underwriter having some sort of built-in bias or systemic issue as well? There's been a lot of talk about algorithms and how some algorithms that are being used have built-in bias. What about the collateral underwriter that Fannie and Freddie have?
I mean, I think you first of all need to recognize this, and again speaks to the importance of the appraiser. There is a degree of garbage in, garbage out. Somebody's got to collect the underlying data. You can come up with a model, but your model and the predictability of that model is only really going to be as good as the data that's collected. And again, Zillow's blowing themselves up and losing lots of money is the best example of that.
Right.
And I know the guys at Zillow, they mean well, and I think they've got good models. But again, it's that you get, this also goes back to 2008. Remember when, everybody thought that these, private label mortgage-backed securities, all this stuff was going to perform wonderfully.
Sure.
I remember sitting around in 2006 and 2007 talking to, Moody's and S&P and all these places where, their models are like everything's going to be fine. Again, there are limitations to this. And I'm a big believer in the model should be part of the conversation. So I'm not a Luddite. I'm not, we can't use it's got to be part of this. It's a data point. It's part of the conversation, but it can't be the end all be all. So you've got to make sure that somebody is out there collecting quality data and somebody who knows what they're collecting.
So that would probably be an appraiser than collecting that quality data.
Someone who's trained to know what to look for.
Yes.
Yeah. So there is a role for that. There's an importance for that, and also because the real estate market is quite cyclical. Just because you've gotten data from an appraiser 3 years ago doesn't necessarily tell you what the value of that home is today.
Yes.
So data gets stale over time. So to me, I think we need to be weary about abandoning the process or moving away from it too much. And of course, modeling itself, you get a lot of different outliers. And again, every home is somewhat unique. And that's one reason why, Zillow and had such big losses from that. It's because, again, it's not like what their models were inputting were wrong. It's just that what they were leaving out.
Right.
And it's very hard to kind of absorb all of those variables. And so, yeah, I certainly believe that half a dozen, or a dozen so variables can tell you probably 80% of the variance in a home value. But you still got the other 20% of the variance. It's a pretty big deal.
The 20% is a huge deal, Dr. Calabria. It's a huge deal. And a matter of fact, the National Association of Realtors, during their surveys, usually said that at any given time, 10% of the sales contracts do not come in at the sales price when it comes to the appraised value, right? But that 10% is so important. Because if you don't value it correctly, then it creates another comparable. If you would, the system believes its own hype as it continues forward. That's the problem with it.
It really is a big problem. And, of course, it's compounded because over time we've so kind of eroded the concept of a down payment. I mean, FHA is the leading edge of this, where it's not only that you can get a 97 LTV, you can roll in the closing costs. And so the fact that the typical FHA HUD borrower leaves the table functionally over water.
It's true. It's true.
But it is true. And it means that the appraiser is that much more important.
That's
because
right.
If the appraisal is off, you're even more underwater. So I would say that, maybe some of these issues have probably always been with the industry, but the trend in the last, probably 30 years of and again, on the other hand, there's a shockingly large number of Fannie and Freddie borrowers who have LTVs that are like 60, 70. So there's a large chunk of that.
Right.
But the worrying part is there's a 10% of the tail that really are functionally underwater when they leave the closing table. And again, the accuracy of the appraisal is so much more important. So where I'm going with this is we're actually over the last several decades put more and more weight on the accuracy of the appraiser.
Yes.
And at the same time that we've tried to move away from it in many ways. So it is a concerning trend, and I worry that we are lulling a lot of homeowners into a sense of complacency.
Is the Fannie Mae and Freddie Mac book, because especially now that there was a lot of refinancing done in 2020, 2021, is that book more solid today than it has been in the past?
Yeah, that's probably fair because certainly we had a lot of turnover in the book. As I mentioned earlier, we were able to reprice certainly much of the part of the legacy book, so it's better cash flow wise. We really, and again, I was not loved in the mortgage industry because of this, but we really kind of put our thumb in the scale toward just doing rate refis rather than cash outs.
Yes, I remember that.
We made it much more difficult to do cash outs, and partly this was one of the big factors we saw in 2008 was a lot of the delinquencies were cash outs. I mean, people would pull tens and thousands, $100,000 out of the house and then walk away. And there was also this sense of there was all the stimulus being spent. We were sending relief checks to everybody and their brother. We did the beefed up UI.
Right.
And so, and quite frankly, one of the fundamentals was we certainly didn't have the capital at Fannie and Freddie to take additional risk. So if you take the basic rate refi, and again, this was only limited. Much of these opportunities were only limited to loans that Fannie and Freddie already held.
Right.
So if you start from the premise of we have the credit risk on this loan today, and if we let that borrower refinance without taking any money out, their monthly payment will decrease.
Right.
So it's actually a more sustainable loan. Their DTI should fall. So you have a more sustainable loan on credit risk you already own. And given the shortage of capital at the companies, it allowed us to kind of support as much of the market as we could. Because, again, keep in mind, Fannie and Freddie were still, I think, coming into COVID probably about 200 to 1 leverage, 150 to 1. So still massively leveraged. Our ability to take additional risk, and this is the real tragedy of not really having Washington deal with Fannie and Freddie for over a decade, is that by the time, again, you want to use the good times to fix the roof,
right,
so that
exactly.
when it rains, you're fine. Well, that was not done. So only to the extent that we tried to do that in the months leading up to COVID, which we got lucky to some extent, we had that runway. We could have done more had Fannie and Freddie been in even better shape, but they weren't. So we were boxed into, didn't have capital to take a lot of additional risk. And so we did make sure that what we were doing was improving the credit quality. Mm-hmm. Now, unfortunately, the Biden administration has weakened some of the underwriting standards since I left. I think that's unfortunate. My predecessor, Director Watt, had weakened some of the underwriting standards. We really tried to tighten underwriting standards. Mm-hmm. And, of course, people were complaining. There was a lot of complaints about that during the crisis. But I really looked at where the market was going in the second half of 2020, and so this is not sustainable. And I have a responsibility to be the unpopular guy who says, how do I make sure that I'm putting people into sustainable home ownership, not just running it through the mill?
But that's part of being a regulator. But that's part of being a regulator.
It really is.
Because you have to be the unpopular guy sometimes.
Exactly. And if you're not willing to do that, don't be a regulator.
Yeah,
being
we
a
have that
regulator,
problem.
Being a regulator should not be a popularity contest. And unfortunately, and it almost too much is. So
when you look at the coronavirus, right, and you talk about raising capital. You talk about holding steady to the cash out refinance, because I remember The Matrix. I remember seeing The Matrix that was developed at the time. Coronavirus, like it or not, if you pick up a prepper book, it kind of followed the pattern of every prepper out there. First there was a run on toilet paper, then there was a run on guns and ammo, then meat, and then beans and rice and all this stuff, right? But the one thing there wasn't a run on was cash and equity. There wasn't the equity stripping that could have taken place very quickly if it wasn't for you holding back that momentum. Your thoughts on that?
That's true. I mean, at the risk of being immodest,
No, you can be cocky on the show. It's okay. You're allowed.
And it's probably I took a lot of heat for it at the time, and probably still there are probably plenty of people out there who would give me heat for it. But we really looked at, part of it, of course, was, like I said, we saw a tremendous amount of assistance being sent to households, particularly those who were refinancing. So we really saw no reason. It'd be different if we were in a deep recession and there was nothing being done and you wanted to have, and you could still do cash outs. Yeah, right. You could. So to be clear, we didn't ban them. We just made them a lot less attractive than doing rate refinance.
That's right.
And so we tilted that playing field in a way that made sure, and again, I would have preferred that to have inherited a Fannie and Freddie that had a lot more capital. But I inherited the Fannie and Freddie I inherited. And those were two companies that were on the brink of failure. And we needed to make sure that how do we keep them from failing while also supporting the market. So it really was threading the needle. And I think we did it well, and that's hence the purpose of the book, to kind of tell that story, but also so that others in the future can kind of go back, because hopefully not a pandemic, but we'll have stressed environments again in the mortgage market.
Yes, we will.
And I hope that some of these lessons, because, part of the theme of the book was really my takeaway from how poorly I thought things were handled in 2008 and why I thought I would do it differently and why it did turn out better this time around. It wasn't by chance or coincidence. It was because we, planned it to be a better response this time, and it worked. And of course, a lot of that meant we were getting criticism from a lot of camps. But again, don't take the job if you're not willing to kind of take the heat. And probably. And again, I definitely, I suspect appraisers feel like this a lot of the times too, where you're getting the pressure and you're getting the complaint that it's not the number somebody wants.
Yeah.
And at the end of the day, it's the same message. Don't go into the industry if you're not willing to, actually go where the data, leads you, where your training leads you.
Very well said. Very well said. If you can't take the heat, don't get in the kitchen.
Yeah,
and honestly, appraisal is a discipline. It really is. Being a real estate appraiser is a discipline that you have to live basically on a daily basis. It really does impact you that way. One final question, if you don't mind, because a lot of appraisers like you. A lot of appraisers think you're awesome and cool, and you made them a ton of money, indirectly, not you personally, but indirectly. If I today And I have the power to do this, by the way, Dr. Calabria. If I today made you the king of all real estate appraisers in the country today, the president, the king, what would you do in a leadership position? If you were the president or the king of all appraisers, what would you do?
And I don't have the choice of immediately abdicating.
Nope, you cannot abdicate. Nope, you can't do it.
So as I kind of mentioned earlier, and you arguably need, there's a lot of great leadership in the industry, obviously, including yourself. To be probably king, if you will, would really first and foremost be a voice for the industry to help everybody else, the stakeholders understand, particularly borrowers understand that this is a consumer protection element of this.
Yes.
And so, the first foremost thing, and this was actually part of what I tried to do as director of FHFA, is be a voice for the agency and be a voice for smart regulation and why it's what the industry needed. And this is true for the appraisal industry, which is, how do you have, a defender and an advocate who can really project to others the value that the industry provides.
Yes.
And again, I really do want to energize people to get out there and make the case for themselves, because I will tell you the steamroller in Washington is to try to, minimize the role of the industry.
Yes, I know.
And I think that's something that really, and honestly, I thought before I was at FHFA that some of the concerns were exaggerated, but when you see it up front, it's one of these things where just because you're paranoid doesn't mean they're not out to get you. There's a big degree of truth to the concerns that the industry has, in regard to this. And again, to be king means to be a leader. So let me just put it this way: if you're going to be king, and I'm one of those people who believe that, if the king is going to lead a battle, he's got to be the one on the horse in front leading the charge. And that's what I would try to do.
Very, very, very well said. Well, listen, I want to tell you something right now. We really do appreciate you being on the show. I did meet you in 2019 because I was at the American Enterprise Institute when you gave your speech. And then when you were done, I was like, Dr. Calabria, and you just got out of there quickly because I think you had Secret Service at the time. I think they had that.
I've got security. I had security. They weren't quite Secret Service. Didn't have guns. They were very good, and I was very good at just trusting them to tell me where I needed to be at any one moment. But I really appreciate everything the industry does, and appreciate the show, and I really do hope that folks enjoy the book. It's not just a policy book. I think there's some humor in it, some insights into Washington. So it really was meant to not just be an educational read, but an enjoyable read.
Well, it is very much so. Ladies and gentlemen, the name of the book is Shelter from the Storm, from Dr. Mark Calabria. Dr. Calabria, will you please come on the show again sometime soon?
I would be delighted to.
Well, listen, my friend, you have a wonderful day, and we thank you very much.
Thanks, and be well, everyone.
So that was Dr. Mark Calabria, Kevin. What do you think about that?
Wow. I do have to say for everybody out there,
yes,
get the book. Once you open it, you're not going to put it down.
It's a quick read. He's a great guy, and not cocky, not arrogant at all. Did you pick up on that?
Yeah.
He's had all these accomplishments. He was in charge of FHFA. He's one of the most down-to-earth regulators out there. And, I got to say that's an excellent quality because, some of these people that you get out there in these regulatory positions, including the appraiser regulators, right? They get up there and, I'm the regulator here. No, you can't touch me because I'm the regulator. That's not what you get from Dr. Mark Calabria. So we're very happy to have him on the show, and that was awesome. Ladies and gentlemen, we have come to the end of our show for this week. And as always, I would like to thank you for listening as we journey through the mysteries and complexities that are in fact, the real estate market. I would like to thank our guest, Dr. Mark Calabria, for being on the show, for his thoughtful insight and knowledge. God willing, we're going to be back here very soon, continuing to report from the front lines of the real estate market. In the meantime, you kiss your spouse, you hug your children, enjoy your day, be safe in the field. You've been listening to Phil Crawford on Voice of Appraisal. We'll talk very soon.